in the event that we do see a situation where interest rates adjust, where they go higher because we've made these good investments that everybody is talking about, I wonder how that adjustment period works, because as you've already mentioned, we have a big debt pile sitting out there, not just on corporate balance sheets, where I think a lot of it's concentrated, but also student loans, household balance sheets. And I wonder how that transition period works.
Well, this is why I said that it's important to recognize that the interest rate is going to be endogenous. And here's one example of that. When you have the levels of debt in the private and the public sector of the kind that we have, just do a thought experiment, raise interest rate all across the yield curve by 1 percentage point or 2 percentage points. The implication of that for the rise in debt service for households and for certain corporations and so on would quickly suggest that it's not sustainable. Households will have to cut back on their spending significantly. Some of them may not be able to do that, and hence might have to default and so on. What that tells you is that if that were to happen under current circumstances, there's likely to be a significant slowdown in the economy, because aggregate demand will slow down as the weight of rising debt service will pull the economy back down. So what does that mean? That means it will be difficult for interest rates to rise for a country like the US. Of course, if you are a small country and interest rates are exogenous for you, what can you do? You'll have to just adjust through belt tightening and so on. But my point is, for a country like the US, which is the core dominant country, their interest rate wouldn't be then set lower. And so, central bank will obviously step in and lower interest rates to try to lower the debt service burden, which is coming from the rise in interest rates in this thought experiment that you're asking me to run. And so that's and that's the core issue, that with such high levels of debt, interest rate, of course, has to be low. It's a very obvious point. The deeper question here is, can you live like this? Can you live as a strong, stable society at interest rates close to zero? And the point I would make there, and this actually connects to some of the conversation that you were having with Kristen, that very low interest rates are not conducive for social mobility in an environment where you have a class of people that have much more wealth than the others. Take the racial gap, for example, or the young versus old gap. That's another way of thinking about it. People who were able to buy assets for whatever reason during the 80s and 90s, they have seen the value of the land that they own and so on rise a lot over the years. And they have enjoyed all of those capital gains. The younger population and Black Americans who did not have that wealth, for whatever reason, even when they enter the job market today, they are finding it increasingly harder to buy the same assets. So you can, for example, you can look at home ownership rate at the same age for the same income level for Black Americans, for young Americans, for example, today. And their home ownership rates are much lower relative to the same cohort of an earlier generation. Why? Only because valuations have just gone so much out of their reach. This is a natural consequence of this persistently declining interest rates that boosts asset valuations, because asset valuation is just the inverse of interest rates at some level. This is the problem that we are facing between the haves and the have-not. And that's why I go back to the basic point that I made in the very beginning. It's a structural problem we are struggling with. And we need to address it both on the supply side as well as on the demand side through some of the actions that Bharat and others on this call have already talked about. I think that is the core issue of the day. You can't just can't deviate from that focus.